This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We look now at project management. I think an increasingly important area of the syllabus. And first, what do we mean by the term project? Because we use the term kind of automatically, and it's worth seeing why we use it in certain places or what characteristics a project has. And first, a project has by its nature, it is non-routine. It is something separate from our ordinary work. It has a distinct start and end. Unfortunately, it's often grafted on top of our ordinary work. So the project time and the amount of effort we can put into it may well be competing with our ordinary work. Often the project is there to solve unique, non-routine challenges, novel challenges that maybe nobody in the organisation has ever had experience of. Perhaps you're given the project of finding a new IT system and looking after its implementation. Projects, once they get any size, you nearly always have team members. You're just somebody maybe from the accounting department, somebody from IT, somebody from manufacturing. So you're bringing together people who maybe have never worked together before. They've got different backgrounds, different vocabularies in terms of their terminology. And also, very importantly, they want different things from the software or from the project outcomes in general. So people from the accounting department might want a system with very good internal controls. People from manufacturing want a very flexible ordering of goods and scheduling of jobs. Somebody in sales wants all sorts of information about the people they're selling to and their sales records and the like. The chances are you will not have enough money to please all of these people, and therefore you're going to have to make compromises. But then people get very political about it. They begin asking for more than they really need in the hope that what they end up with is what they want. And there'd be conflicts and jealousies over the resources given to them. And finally, for many projects, there is no benefit until the project is finished. A half-finished system to put in just in time is not going to do anybody any good at all. Or a half-completed accounting system may not be much good. So what you've got spend, and then the project goes live, and that's when you discover whether or not it's going to be worthwhile. And if you were to stop the project 2 years through out of the 3, you're probably not going to get any benefit. And all of this really deals with risk. Projects can be quite risky and they can go very badly wrong. And if I would say one thing that you have to really watch carefully, it's what we call the scope of the project. What is the project going to do for us? What are what's called the outcomes, the results, if you like? This should really be settled at the start. We set up here that these different team members have got different priorities. The chances are they're not going to get all of their priorities, all of what they want. And the dangerous way of making a decision is to try to suppress this kind of conflict and kind of hope that it will sort itself out as it goes along. Because it won't. What you should do is take the hard decisions at the start and say, you're going to get that, but you're not going to get everything. You're going to get that, but not everything. You're going to get that, but not everything. So we know precisely what this project is going to do, and any changes partway through are going to be minimized. Projects are important in strategic planning because any large 5-year strategic plan affecting all of the company can't really be done as a once-off event. The way to control it is to break it down into little bits. Each little part is a project with a start, a duration, and an end. You can give somebody precise responsibility for achieving that part of the overall strategy, for achieving that project. You can give them a budget to be working to, and you can say, your little part of this strategy, your project will produce this, this, and this. And if every project and every project manager manages to come in on time, on budget, delivering what is required, then you're going to get the whole strategy produced. It's like really fitting together the pieces of the jigsaw set. The picture will be complete once all the parts are assembled. The stages of a project can be broadly described as this. You can get various different stages, lists of stages. This is as good a one as any, really. Sometimes you'll see this at the start. This is a kind of screening process. And you look at proposed projects and you simply say, that's never going to start. That's so ridiculous, so dangerous, so expensive. I'm not going to look at it any further. So you get rid of the really silly ones, and then you're left with ones which might possibly be worthwhile. And what we have to do, and sometimes these are actually done kind of together as part of the same appraisal, is risk assessment and the business case. Risk assessment is looking at what could go wrong in this. How could we harm our stakeholders? How could we maybe run into practical or legal difficulties? And there are 4 ways really of dealing with the risk here. You can remember with TARA, or I'll do here the 4 T's here, you can terminate. You look at the risks and you say, these are so great, I just don't want to go near them at all. I simply won't embark on the project. You can treat the risks. In other words, maybe instead of computerizing the whole company at once, you maybe computerize one branch, get it working well, get all the problems ironed out in one place, and then you can spread relatively painlessly throughout the company. You can tolerate it. All business activities have some risk, and at some stage you have to put up with them. You have to say it's worth it. I will just suffer and live with the risk. And sometimes you transfer it. So if you were developing a software package, maybe rather than doing it yourself because you're not quite sure if you've got the right expertise, maybe subcontract it. Another way of transferring risk is to insure against things going wrong. We'll see the business case on the following screen, but basically it is to justify it in business terms. You've got costs versus benefits. In a profit-seeking organization, you will probably try to get the benefits in terms of money, and you want to see a kind of positive outcome between costs and benefits. But you have to do a business case even in non-profit-seeking organizations. For example, a hospital. Hospitals have got limited resources, and we have to decide, I'm going to spend this $500,000 on a new scanner, or am I going to spend this $500,000 on maybe a new operating theatre? And you will have no criteria really in which to make that decision unless you've got some attempt at measuring the benefits you get from both of those sorts of expenditure. Nobody should go into any sort of project without some idea, for these costs I'm going to get these benefits. You need to go through some sort of justification. Then we'll have the detailed project plan. This says who's doing it, by when should it be done, how much is it going to cost, who's going to pay for it, who's going to say that it's working okay, are we going to have it done in-house or are we going to have it done externally, who's going to be the project manager, who's going to be the project team. So it's all of those who, why, when, where type questions, how much and so on are going to be in the project plan. It can be very, very detailed. It can be mapped out week by week in time, achievement and expenditure. You do the project, and of course what you have to do is to, in the execution here, you have to kind of keep monitoring it there. Are we on target for time and cost? Do we need to change in some way what we're going to be doing? Do we need to maybe throw more resources at it, or do we need to tell people this is going to be a little bit late? And finally, at the end, closing, we have delivery and review. You hand the finished project over to whoever is going to be using it, often the sponsor. And then you have to do 2 sorts of review, which we'll see. How did we manage the project as a kind of technical event? And is the project worthwhile? Are we pleased with what we were getting? And you can learn both from good things and bad things in these reviews, but you do need them. Now this idea of project gateways is a methodology. If you see it written, you'll often see TM above it, trademark. it is trademarked to the UK government, who are often running very large projects, for example in IT or health service or defence, anything like that. And what the idea of a gateway is that you're not allowed to progress to another stage of the project unless previous stages are fine. A gate stays closed, and only when you prove to people you've done things right so far will it open and you're allowed to progress. So first of all, you do your business case. You develop the business case, and then of course what you must do is have that independently reviewed, because the people who want the project to go ahead will almost certainly come out one way or another with a positive business case. So you want it to be independently reviewed, the business justification. And if those people are happy with that, then gates open, you can pass on to the delivery strategy. For example, are we going to outsource it, do it in-house, have a mixed team? And again, that should be reviewed. People will say, do you have the expertise inside? What's it going to cost if it goes outside? What are the times like inside versus outside? And we need a proper, rational, considered decision, reviewed, and then we can go on. If we're going to be doing it by subcontracting, then we have to make sure we get the right subcontractor through competitive procurement. We maybe get 3 people replying. Should we be going on the lowest cost, or should we take quality and reputation into account, and maybe guarantees and so on into account? What you don't want to do is just keep going back to the same old supplier because you know they've got some sort of long-standing relationship. And again, the very important step of awarding a contract needs to be independently reviewed before you're allowed to go on. If you're allowed to go on before these reviews are passed, you're kind of throwing good money after bad. The project's kind of gone wrong at an early stage. It's very hard to rescue it at a later stage. If it's software, you design and build it. Gateway Review 4, make sure that the software is actually working before you try to put it into operation. You put in the service, and what you're going to do then is to make sure that we're all happy with it. Is it producing the benefits that we thought it would be doing? We want an independent report on that. What you need also to look at is this bit here, this Gateway Naught review. You could have a project going absolutely perfectly, passing every stage. Let's say the project was started at the beginning of 2007. Fantastic business case, great investment decision, etc., all going well. And then the banking crisis happens out of the blue. The whole project, no matter how well it is going, no matter how well it had been justified, maybe now should be abandoned. Maybe the business rationale has disappeared. So what we have to do is to keep this kind of strategic assessment in hand. Is the project that was once worthwhile doing, is it still worthwhile doing? Business case, if you remember back in F9, the problems would say a company is considering a project. And it would say the cash outflow at time naught is this, the inflows and so on there. And certainly most people would say that net present value is by far the best way of judging a project where you're spending now, getting benefits later, there's a time difference in there, and the time value of money is important. You could use, of course, inferior methods like payback and return on capital employed. We should also be aware that everything plugged into a DCF calculation is essentially an estimate, and we need to think of sensitivity analysis. How far could an estimate change before we hit zero NPV? What are the risks that are attendant? How likely is one of these estimates to actually change? And we can use forecasting techniques, we can use probabilities and expected values and so on to try to get some sort of idea of what might happen in a situation which isn't absolutely clear cut. Usually the costs, the time zero outflow is going to be by far the easiest cost or cash flow to assess. What is going to be much more difficult is assessing benefits coming in, maybe 5 years, 6 years, 7, 10 years away. How on earth are we going to estimate those? Indeed, what are these benefits? And a couple of writers called Ward and Daniel came up with this idea that the benefits can actually be divided into 4 categories. First of all, you have observable. You can't measure these, and very often you can't predict that they're going to happen. But maybe you put a new IT system in, and after it's settled down for 3 months, you see that your staff seem happier. The morale is higher, they seem to be less harassed. And maybe what it is this new software system is allowing them to do their jobs much more efficiently and much easier, and this has produced a happier workforce. Now that's undoubtedly a benefit, but it's going to be quite difficult to measure that, and it could have been very difficult indeed to anticipate it with any sort of accuracy. So it's nice to have, but it's not easy in any way to bring into any sort of NPV calculation. Secondly, we have measurable benefits. Measurable means you can measure, you can get a number on it, but in particular with Ward and Daniels, it means it's not predictable. So I could be maybe assessing a new inventory system. I have hopes that the new inventory system will lead to fewer stockouts, so I'm going to be turning fewer customers away, saying, I'm sorry, I don't have the goods. Now, presumably over time, our reputation of being a very reliable supplier will rise. And as our reputation rises, presumably our sales revenue will rise. And of course, we can measure the increase in sales revenue, but it's going to be very difficult to predict how better stock keeping will give rise to better goodwill and reputation, will result in higher sales. Quantifiable benefits are measurable plus predictable. So they can be measured and we can predict them. Perhaps we've been told that if you have this inventory system, it will cut the volume of inventory by 10%. We know from other clients that this will reduce the volume of inventory by 10%. So there we can certainly measure it afterwards, but we have got maybe a good statistic to predict it. And then once you've got to the quantifiable benefit, you're often not that far away from financial, where you turn this quantification into an amount of money. And so at that stage you can actually put it into the discounted cash flow calculation. People are particularly exercised, particularly interested in how can we get from measurable to quantifiable. We believe that there's going to be a concrete improvement, but we'd really love to be able to predict what it is so we can evaluate the project, do a proper business case. And ways in which you can do that is maybe a pilot operation. Put the software into one branch, measure how the increase in sales is going, maybe how the reputation of the branch is improved. And if you get positive results there, then maybe you can extrapolate that over other branches. Sometimes we look at what competitors are doing. They're using it, they seem to be trading very well. Maybe we can pick up some information about the measurable amount of improvement that we could possibly be expecting. Sometimes mathematical techniques, simulation, can be used to mathematically predict how maybe putting an extra checkout lane in a supermarket will increase the through flow of customers and lead to less frustration at large queues at checkouts. Project risk, something we need to keep track of here. These are determinants of project risk. If we look at how well the project is defined, how well its scope is defined there, it can be very well defined or very ill defined, very hazy. So a project which simply says we're going to improve inventory, everyone hearing that phrase, improve inventory, has probably got a different idea of what it is. Does it mean more inventory so that we never run out of stock? Does it mean less inventory so that it costs less? Or does it mean we're going to introduce better refrigerators so we keep the inventory in a better, fresher condition? The phrase better inventory is a hazy phrase. You need to be very specific indeed in this definition here, which is really the scope. Secondly, the size of the project. I think it's pretty obvious. If you've got a very large project affecting many departments, many stakeholders, there is more risk. It's going to be harder for you to control. If you're a nice little small tidy project, less risk. And finally, the complexity of the project. A very complex, almost leading edge project, almost an experimental project, maybe on predicting demand or just-in-time inventory or something. Plenty of places it can go wrong. But if it's just a rather dull old project, putting sage accounting into somebody's system, a really well-known, ordinary sort of accounting system, not much can go wrong. All of these can move kind of independently, but I would suggest that if you are given the opportunity of being put in charge of an ill-defined project, which is very large and which is very technically demanding, you might try to get out of it, because it probably won't work. I'm not saying that you shouldn't have large projects. I'm not saying you shouldn't have complex projects. Sometimes you need to risk going for those. What you should never have, really, is a hazy, ill-defined project, one where the scope keeps changing. That is absolutely a recipe for disaster. An important document in project management is the project initiation document. It suffers a little bit of almost an unfortunate name, this initiation document here. You think it's used at the start of the project and never used again, really. But I think you almost need to think of this as almost the master handbook of the project. Anything you need to be able to find out about the project should be written down in this project initiation document. So we'll carefully define its scope. We'll define its deliverables. The deliverables are what it actually produces. It could be a list of reports, for example. This is what it will do for us. You will have your cost-benefit analysis there. We need to keep an eye on the costs. We need to keep thinking, are the benefits going to be real? We've analysed the risks, so we need a document where we can go and look at the risks, because we need to make sure that we take care in the risky areas, not to do some damage. We need to find out who's paying for it, which departments are paying for it, who's in charge of the budget. And we need to know how much there is. We need to know maybe who to go back to if we're beginning to break the budget a little bit and ask them perhaps for a little bit more money. We have to define responsibilities. In particular, there's the project sponsor. The project sponsor is really the person behind the project. It might be the manufacturing director who wants better control over the manufacturing process. There's a project manager. This is a person who looks after the day-to-day implementation of the project. And then there's a project team, maybe half a dozen people drawn from different areas of expertise who should be meeting regularly to review the project and its progress. So this should be giving people all the information they need to implement the project. Again, it's the what, the why, the who, the why, the where, the when, the how much, and so on. They should all be kind of crystal clear from this project initiation document. Because if they're not, once things going wrong, you can see people hiding. If you haven't pinned responsibility on people, if you haven't got a specific cost and so on, particularly once they begin going wrong, a lot of blame begins being thrown from person to person, and people try to escape their responsibilities. Project manager, quite difficult really to find good project managers. They need a kind of very unique set of skills. They need to be very good at team building. They need a lot of diplomacy and building this team together and telling people, well, you're not going to get everything you want, but you can get this. They have to have negotiating skills, maybe with a sponsor. Look, the project is going late. Would you like to spend some more money on it to speed it up? Are you happy with it being late? Or would you rather us maybe reduce some of the things it does, actually reduce the deliverables slightly, so you get 80% of the project done on time? We have to report costs, we have to keep track of time, we have to be able to delegate to people in the project so that everybody knows what they're doing and what's expected of them. The project manager also has to be expert in running projects, sometimes with special software in running projects. And ideally, they also have some expertise in the project subject matter. So if you're doing something in manufacturing, someone from a manufacturing background may be suitable. If you're doing something in sales and marketing, maybe somebody from a sales and marketing background might be better, who understands the sort of maybe information needs of that department. Project team, not going to say very much about these here. About half a dozen people maybe. You want the right mix of knowledge, know-how and skills, but also you want the right mix of personality types and so on. You don't want too many people who want to be the headstrong there. You want some people who are very good at attention to detail. A nice mix of people with complementary skills and personalities is what you want. When you're running a project, you have to normally bear in mind these 4 criteria. You want the project to be done on time. You want it to be done in cost. You want it to do what you said you would do. You want it to achieve the deliverables. And you want to achieve quality. And this diagram is really just a little bit of a warning that one of these tends to be the bully, tends to be the most important. So let's say in a month's time, the taxation regime of employees was changing and you had to have a very radically different IT system to cope with people's income tax on their wages and salaries. And if the system isn't working, then you're going to find it very difficult to pay people. Now, in such a situation, time is the most important thing. If you don't get this finished by the end of next month, we won't be able to pay employees, and that's disastrous. And all I'm saying is, if you're saying we must get it done on time, some of the other things might be let go. You might get it done on time by throwing money at it, employing more subcontractors, paying more overtime. You might get it done on time by cutting it down, that you only end up with 80%, but the most important 80% done. Or, and this is not to be advocated, what you might do is skimp on testing so that the quality of the project is put at risk. Similarly, if what you're told is you can spend 200,000 on this project and not a cent more, then the others are at risk. It could take longer to do because you won't pay people overtime. You skimp on the scope, it does less. And again, you don't do all the quality tests you should, because again, those are expensive. So we're trying to keep really these 4 things balanced here, without letting any one of them kind of take over the rest and dominating them. Now, by and large, accountants don't find too much difficulty in dealing with the cost of projects. All you have to do is to give the project a kind of account number, and every purchase invoice to do with that project, you code it with that account number, and the costs accumulate in like a contract account. You can give people timesheets and a special code for working on the project so that the time and the wages accumulate. So we don't find that a mystery. When it comes to recording time, keeping track of time, things are actually slightly more involved, more difficult. And one method is to use critical path analysis. You don't have to know how to draw one of these, but you should be aware of maybe what's meant by critical activity and indeed a critical path, the concept of critical path. Here we have a project set out in diagrammatic form, the A, the B, the C, the D, and so on. These are all activities, little elements of the project. The 6, the 7, the 3, the 5, and so on are the duration of the project. The duration of the activities. I must say in this example the durations are not realistic, but they will serve their purpose. And let's say this is a project which is building a house. And what the critical path analysis shows is that some activities have been carried on in parallel, whereas other activities have to be one after the other. So, if we think about building a house, let's say A here is putting in the foundations. So you dig a trench in the ground, you fill it with concrete, and this is going to become the base of the house. And then activity C, this could be putting on the bricks. So brickwork. Obviously you have to have the foundations in first before you can put the bricks up. But what we could be doing at the same time is in a factory somewhere we could be doing some woodwork. And what we'll say in the factory, we'll be making the window frames and the roof beams. So that's done in a kind of woodworking factory, and there's no reason why making the windows and making the kind of roof beams can't be going on even before we start the foundations, but we'll start it together. So foundations have to be done before bricks, but roof beams and windows can be made whilst those other two processes are going on. Then we come to activity D, and we'll say what activity D is fit the roof beams. So this is basically, you've got your bricks up, we're going to set these A-shaped beams on top of the bricks to form the roof. And what we're going to be doing at the same time is we can put in the windows. So in the brickwork we've got these square holes being left, we put in these the window frames and the glass and so on. But you have to have the bricks up first before you can either put on the roof beams or put in the window frames. And the last step will be put a covering on the roof now, on top of the roof beams. Let's say it's going to be tiles. Some sort of covering. But obviously you have to have the roof beams on before you can do the tiles. So that sets out the kind of order in which you can do the different processes or activities within the project. And then what you can do is you can go through every pathway in the project, adding up the durations. So we can go A, C, along the top one there, we can go A, C, D, F. You add up those durations, it's going to be 6 plus 3, 9 plus 5, 14, and then 17. And then the next one we can go A, C, E. So 6 plus 3, 9 plus 9 is going to be 18, and so on. And the longest way through is determining how long the project will take, because it is really the sum of the most serious activities that have to be one after the other. So here we see that the longest pathway through the whole project is ACE, and the critical path length is 18. This means that we can't accomplish this project in anything less than, let's say it was weeks, 18 weeks. Furthermore, it tells us which activities here, A, C, E, form the critical path, and these become critical activities. If activity A were to take 7 days instead of 6, then it would push the completion of the project up from 18 to 19. In other words, we've got no flexibility on these critical activities. Activity B is not on this. Here's B and here it's got 7. But if you like, it's kind of in a space there, 6 there, 3 there. It's taking 7. It's almost got a space of 2 days in which it can kind of move around or take slightly longer. The project manager doesn't need to worry quite as much about non-critical activities, but the project manager needs to be watching really carefully the critical activities. If they are going to be slipping, this is what needs attention. Maybe we could move some of the workforce from one activity where there is some spare time, some slack, onto a critical activity to make sure it's done on the time. Now the next slide shows another representation of exactly the same project. This is what's called a Gantt chart. And if we look at this here, we've got activities A and B starting together. So A took 6 weeks, B took 7 weeks. So here we have A ticking out here till 6, B can start at the same time ticking out to 7, Once A is complete over the foundations, then we can put on the brickwork. And you have the little dotted line here showing that activity B can move around for 2 days within the 9 days gap. And then once the brickwork is on, then we can start putting on in the windows. We can start in here putting on the roof beams, put in the windows, and then put the tiles on top of the roof, all with some of them with the little bits of slack, as it's called. And again, we come up to 18 here as the project path length. And there is one of the early questions that was set by the examiner does effectively have a Gantt chart in it. It was looking at the implementation of some IT. It was asking you to look at that and say, well, something is slipping behind time. Where maybe do we have some flexibility to juggle stuff around a little bit so we don't delay the overall project too much? But it's very much interpretation of this, not drawing it. Benefits. Some terminology now. The benefits owner. We had a business case with cost versus benefits, and who is in a way responsible for making sure the benefits come out. So the benefit owner is the person who has authority to make business decisions that will actually help deliver the benefits. So if what we're trying to do is a project to stop people ringing up and asking for help, the project is to try and put a lot of help online, then there has to be someone responsible for getting your customers to stop ringing you up and to use the frequently asked question pages or the forums to try and get help that way instead. Because if they don't shift over from telephone queries to the online system, we're never going to get the benefit. So this person defines, agrees and delivers the benefit defined in the business case. The buck stops with them in terms of achieving some useful outcome. With a benefits map, where does the benefits, where do they actually kind of arise from? How do they help the organisation and so on? So a benefits map, if we're trying to get people to use an online help system instead of ringing us up, what has to be put in place? Well, you have to have a good online help system. You have to maybe have some searchable database. Maybe what we have to do is analyze the existing problems that people have had. Maybe what you need to do is to make it rather difficult for people to keep ringing up, maybe make it expensive to ring up and so on. So the benefits map shows how you actually achieve the benefit, what bits and pieces of action have to be put into effect to see the benefit coming through. And of course the benefit owner should be very fully aware of what the benefits map is. Benefits realization. Benefits realization is making sure that we actually go the final step and get the benefits. Again, we could have this marvelous online help system that's working tremendously, but if people still keep ringing up, we're not going to be saving very much money. In fact, we'll have invested money in something that's not being used. So what we have to do is to make sure that those benefits are realized. The benefit owner should be taking these steps. What it might require is being a champion of it, demonstrating it, advertising it, training people, sending people emails to say, by the way, try our new online help system and so on. It might mean hiding the phone number. It might mean putting a premium price on actually ringing the helpline to push people over towards using the online help system, which we hope is going to bring the benefits by saving costs on having people to man the telephone help system. Finally, we have a completion report showing the outcome of the project, saying what it has achieved, making sure everything is finished. And there are two sorts of reviews in here. A post-project review is a report about the project. How technically well did the project run? Did we come in on cost? Did we come in on time? Were there any, fights almost amongst the project team and somebody went stomping off because they weren't getting what they wanted? That would be a kind of failure in project management. And the second type of review we have is the post-implementation review. This is about what the project achieved. In a way, have we got the benefits? Were the deliverables achieved? It's almost saying that if you had your time over again, would you do the project again? Or has it all turned out to be a bit of a mistake that you wish you'd never embarked on? Either way, for both of these here, they could both go well, they could both go badly, but you can learn certainly from your mistakes, but you can also learn from what went well and make sure you incorporate that sort of project management in any future projects which you're running.